Imagine a time of unprecedented prosperity, where fortunes were made overnight and the future seemed limitless. But beneath this glittering surface, a catastrophic storm was brewing. Before we delve into this pivotal moment in history, please take a moment to subscribe to our channel for more insightful content. The 1920s, famously dubbed the Roaring Twenties, was an era of immense economic expansion and industrial growth in the United States, fueled by the post-World War I boom. This period saw a strong public sentiment for perpetual economic and stock market expansion, encouraging widespread speculative activities among ordinary citizens and seasoned investors alike. Many poured their life savings, even mortgaging homes, into the stock market, often buying on margin, which meant borrowing money to purchase shares, pushing prices to unsustainable levels. Then came the fateful week of October 1929. On Black Thursday, October 24th, panic selling began, leading to a record 12.9 million shares traded and a significant drop in the Dow Jones Industrial Average. The market continued its downward spiral on Black Monday, October 28th, with an unprecedented 12.82% loss in the Dow, setting the stage for the ultimate collapse. Black Tuesday, October 29, 1929, marked the most disastrous day in U.S. stock market history, with over 16 million shares traded and an additional 11.73% fall in the Dow. Around $14 billion of stock value vanished, wiping out thousands of investors and signaling the end of an era of unchecked optimism. The crash was not an isolated event, but a tipping point that exposed deep-seated weaknesses within the economy, including rampant speculation and the dangerous practice of buying on margin. Weak banking regulations allowed irresponsible lending practices, contributing to a fragile financial system vulnerable to collapse. Government policy mistakes, such as the Smoot-Hawley Tariff Act of 1930, imposed steep tariffs on imported goods, triggering retaliatory measures from other countries. This significantly reduced global trade and output, exacerbating the economic downturn and deepening the crisis. Overproduction in industries like steel and iron led to an oversupply of goods, while wealth inequality meant a vast majority of Americans had little to no savings. The stock market crash, coupled with banking panics and a contraction of the money supply by the Federal Reserve, led to a sharp decline in spending and investment. This ushered in the Great Depression, the longest and most severe economic downturn in modern history, lasting from 1929 to about 1939. Its impact was devastating, with steep declines in industrial production, widespread deflation, and mass unemployment reaching as high as 25% in industrialized countries. Poverty and homelessness soared, leading to the emergence of shantytowns grimly nicknamed Hoovervilles, named after President Herbert Hoover, who was widely blamed for the crisis. The economic crisis quickly spread globally as international trade plummeted, affecting nations far beyond the United States. In response to this unprecedented crisis, significant reforms were enacted to prevent a recurrence. The Banking Act of 1933 created the Federal Deposit Insurance Corporation, or FDIC, to restore public trust by insuring bank deposits. In 1934, Congress established the Securities and Exchange Commission, or SEC, to regulate securities markets and protect investors from fraud and manipulation. Franklin D. Roosevelt's New Deal also introduced numerous relief programs aimed at alleviating the suffering of the homeless and unemployed. Today, financial commentators often draw parallels between current market conditions and those preceding the 1929 crash. High price-to-earnings ratios and a significant influx of capital into private companies and ETFs echo the market frenzy of the late 1920s. Rapid technological advancements, with AI's role today, are compared to the transformative impact of radio in the 1920s, driving new waves of speculation. Furthermore, a shift towards economic nationalism in some regions today mirrors the isolationist policies that followed the prosperous 1920s. However, modern regulations like the SEC and FDIC, along with a more sophisticated understanding of economic cycles, provide safeguards that were absent a century ago. While history doesn't repeat itself exactly, understanding the past helps us navigate the complexities of the present and future. The 1929 crash and the Great Depression serve as a powerful reminder of the dangers of unchecked speculation and the importance of robust financial oversight. By learning from these lessons, we can strive to build a more resilient and equitable economic future. Don't forget to subscribe for more historical insights.